Great. So thank you for joining us today. I'm Katie Belucas. I'm a principal in our not-for-profit group, and I'm joined by Emily Parker and Joe Burns. We're here today to talk through some frequently asked questions that we hear from our not-for-profit client base. So Joe, this first topic is for you. We receive a number of questions about unrelated business income, or UBI. So a question for you, is investment income UBI?
Well, hi, Katie. It's nice to be with you today. I will mention up front, we did do a podcast a couple of months back on unrelated business income, so I will try not to be too repetitive here with some of my answers. But regarding investment income, the general answer is going to be no, not UBI. That's going to be like your interest, your dividends, capital gains, those sorts of investment income items are generally excluded from UBI. There can be a couple of instances, of course, where I have some exceptions to it not being excluded from tax. One such example would be if the underlying investment is debt financed. So, for example, if an organization takes out a loan and uses those loan proceeds in order to make an investment, and investment income is generated from it, that income actually is taxable as UBI due to the debt financed income rules. So that's one instance. Another instance that I can think of where we see taxable investment income is when sometimes we'll get a Schedule K-1 from, say, a partnership investment or a similar sort of pass-through entity. And the Schedule K-1 may indicate that some portion of the investment income is taxable as UBI. That would then prompt us to have to report that specific investment income as taxable income on a Form 990-T, even though generally speaking, investment income is not taxable as UBI.
What about rental income? We have a lot of clients right now that with employees not returning to work, they have office space that they own the building, but they're opting to lease the space out to an unrelated business. Would that put them in UBI territory?
It really depends. Don't you love that answer? It usually depends. The general answer is that rental income is excluded from UBI, generally excluded from UBI if it is rental of real property, so land and building. There are some instances that can make rental income, however, taxable. The big crux, and it's very similar to the investment income example, is if the property is debt financed. So if you have a mortgage on a property, they actually define the term that the IRS uses is acquisition indebtedness. So you kind of have to look to what kind of debt you have. But in a general example, if you have a mortgage on a property and you are renting out a portion of that space, then you are generally may be subject to unrelated business income tax on that rental income. So now I told you land and building generally is not taxable. Then I gave you an example when it is. Now I'm going to give you an exception to even that, which is if you have a rental property and it's debt financed and you are using more than 85% of the space for exempt purposes. So essentially you're renting out 15% or less of the space to somebody else. Then you are allowed to not treat that property as UBI because you are using substantially all of the space for exempt purpose. So rental income is kind of one of those ones that's hard to unpack. The other thing that I will point out is the exception for rental income is specific to real property. I made a point to say land and building. If we are renting out what is called personal property, so if we're renting out like equipment or furniture or something to that effect, that is UBI. Rental of personal property is UBI. So kind of one thing that I would suggest is if you have like a mixed lease, like where we're renting out space and there's also some equipment component, you need to be really careful as to how you have those agreements structured because you can end up tainting potentially all of the rental income as UBI if you're not careful.
Very interesting. So I think if there's UBI and rental income, we're definitely reaching out to our tax professional. Yes. And what about royalty income? Is that UBI?
Royalty income, generally no, not taxable as UBI. There are lots of different examples of what is royalty income. I think the general example that we see most often is, we have either a mailing list or a distribution list that, somebody pays us for access or rights to that list, something to that effect. If the organization is not conducting any services in relation to that royalty income, then it is not taxable as UBI. If there are services that are being conducted in conjunction to that royalty income, then it can taint that income and make it taxable as UBI. So again, I'm trying to give you some quick answers here. You really have to look at facts and circumstances and look at how your agreements are structured. But generally speaking, royalty income, not UBI.
So we know really that nonprofits have to pay attention to UBI, unrelated business income. What about governmental organizations?
Great question. So governmental organizations or municipalities are generally excluded from having to file a Form 990. So you might think, well, if they don't have to file a 990, then maybe they don't have to file a Form 990T, which is where UBI goes. Unfortunately, that is not the case. If you are a governmental entity or an instrumentality that does not have a Form 990 filing obligation, but you do have UBI, you are still subject to the rules and would be obligated to file a Form 990T in those instances.
And so if an organization has UBI, that usually will point you to a 990T. And so it's not a definite no-go, don't do it. It's more of a bring in your tax advisor and make some plans. But we are seeing more organizations subject to the 990T filing with things like certain tax credits, for example, are making it really beneficial to file the 990T.
Mm-hmm. So the Form 990T, there are a couple of instances. So like I said at the top, the Form 990T is the form that we file when we have any unrelated business income activities. There are some other instances where a Form 990T, we may talk about needing to file one. One is in the area if we are claiming some sort of a tax credit. Kind of the popular one right now is the energy credits that are available to nonprofit organizations as a refundable credit. You have to claim that on a Form 990T. Another instance where one may file a 990T if they didn't have any unrelated business income might be if they have any various foreign filings, like if you have a Form 926 or a 5471 or an 8865 because we've made investments in some sort of foreign corporation or partnership. If you file those foreign filings, because you're obligated to, and you file them in conjunction with like Form 990T, the instructions allow you to essentially not have to make those foreign filings available to the general public as part of your Form 990 filing. So there's a strategy there where you can file your Form 990T even if we had no UBI, just simply because we have these foreign filings that we have to do. And then it makes them so that they are not available to public inspection.
Thank goodness for the tax professionals, right, Katie?
Yes, exactly. So thank you very much for all of that, Joe. So also around this time of year, we start to get a lot of 1099 questions. What are some questions that you're getting in this area?
They're all over the place. So obviously 'tis the season right now where we get a lot of the 1099 questions. If I had to kind of pick like a number one, it would be, who do we need to issue a 1099 to? I think that's the question we get most frequently. And it comes in a whole lot of different varieties. But really what's very important is that the organization, ideally before the independent contractor begins work, the organization should be receiving either a Form W-9 or a Form W-8. Form W-9 is what domestic individuals and companies are required to complete, and a W-8 would be a form that a non-resident, so someone from a foreign country, that's the form that they should be completing, would be the W-8. As a general rule, C corporations are not required to be issued a 1099. Now, of course, there's an exception to that. That would be our law firms or attorneys. They, even if they are structured as a C corporation, should be receiving a 1099. Again, general rule here is payments, not accruals, mind you, but payments during the calendar year of $600 or more is what potentially triggers a 1099 filing. Okay, so W-9 or W-8 upfront to identify what type of entity they are, and then issuing a 1099 accordingly if payments are over $600. Trying to think of some other questions we have in this area. I know expense reimbursements is one that I see a lot of. So like we may have a board member that brings in, say, coffee and donuts to board meetings and we reimburse them. Do we need to issue them a 1099? Expense reimbursements generally do not need to be put on a 1099. That's a really important designation. So if you have an independent contractor who is staying here for a few days and they're staying at a hotel and they're submitting, a receipt to the organization for lodging expenses that we are then reimbursing them for, the lodging expense that we've paid does not need to be part of their 1099 compensation, so long as the expense reimbursement is being done pursuant to an accountable plan. That's a question that we get an awful lot, is in this area of reimbursements and when do we need to put those on a 1099? Answer is generally you don't.
So going off of the employee reimbursements or board member reimbursements, are there situations where an employee would receive a 1099 if they're a standard W-2 employee?
Yeah, that's a tough one. So the general answer is that an employee should only really be receiving a W-2. So it does generally raise a red flag with the IRS if you have an individual who's working for an organization that in the same year receives a 1099 and a W-2. Worker classification kind of continues to be one of those hot button issues for the IRS, especially in the EO world. It's always part of their business plan each year that they're going to look at worker classification. There can be instances where facts and circumstances would apply where someone might receive both in the same year. For example, maybe they started as an independent contractor for the first part of the year, and then later on during the year, we hired them on as a full-time employee. It would make sense and be reasonable that for a portion of the year, they were 1099, and then once they became on staff full-time, then they got a W portion of their employment. Another such example might be if there are just two completely different operations that are going on. An example that I'm aware of is like you may have a receptionist who works at the organization and then also runs like a cleaning business after hours with their spouse, and they clean the building and they receive a 1099 to the cleaning services component job that they're conducting, and then they receive a W-2 for their with the organization. So it's generally discouraged. It does raise, generally speaking, a red flag, but you do need to look at facts and circumstances to see how those apply.
Yes, and this is definitely an area where I know, Joe, I've used you several times during client engagements where questions with 1099s, with employee classifications comes up. And so that's certainly something that as these situations arise, definitely reach out to the firm itself so we can make sure that you're setting things up appropriately.
Yep.
So another question that we got recently, really just flat from the client, was I'm a non-operating grant-making private foundation. I recently read something about having to do expenditure responsibility. Do I need to do this? Our foundation only gives to 501c3 public charities.
Okay, so non-operating foundations, those are generally the grant-making foundations. The general rule is that a non-operating private foundation is generally only allowed to make grants to 501c3 public charities. If you make a grant to, and also exempt operating foundations, which is a small subset of other private foundations, they're okay too to give grants to, by the way. But generally speaking, it's those 501c3 public charities. If you are only making grants to other 501c3 public charities, generally you do not need to conduct expenditure responsibility. Expenditure responsibility is an additional onus that is put on the non-operating foundation if they are making grants to organizations other than a 501c3 public charity or an exempt operating foundation. The reason why additional measurements are taken or required is because if you make a grant to somebody other than a public charity, it's considered a taxable expenditure, which for all intents and purposes here, I'm just going to say those are not good. You want to avoid taxable expenditures in the private foundation realm. So the way to avoid taxable expenditure treatment is to conduct expenditure responsibility. There are very large statements. There are questions on a 990 PF that get into the expenditure responsibility requirements. And if you're subject to them, there are also very large statements that have to be attached to your 990 PF that demonstrate how you are conducting your expenditure responsibility. How are those funds being expended? How much is left? How frequently are you checking in with the recipient organization? So it is a rather large onus and responsibility that, generally speaking, you do not need to do or conduct if you are just making grants to 501c3 public charities, which this question seems to be indicating. So something to be aware of, but not necessarily something they need to be actively conducting, so long as they're dotting their I's and crossing their T's and making sure that they're giving to the right types of organizations.
Yes, very helpful. So another thing is we're starting to see significant turnover in finance departments of our clients. Do you know anybody that can help fill this role? We frequently have clients that really are looking for somebody to fill the gap between when the vacancy occurs and really when they can rehire and get somebody onboarded. So Emily, do you know of any ways that we can help?
Katie, that's a good point. We hear questions a lot from folks that turnover is an issue. We know it's something that's sort of been expected, as there are fewer people entering the accounting field than there are retiring and leaving. I know it's something the industry is working on trying to fix, but for now, we see that when organizations either retire unexpectedly or pop jobs, that there's really a period of time that needs to be filled. Of course, we've done some podcasts that we can direct folks to. One is about recruiting nonprofits to the C-suite, and there's another that's about audit readiness. We sometimes get questions of, this person just left and our audit's in 2 months. What do we do? So I won't reiterate what we said there, but there are certainly resources available for folks that have short-term needs. We have an outsourced accounting group. It's not always a great fit for our clients because of independence, but there are other avenues we can direct people. But really what I encourage folks to do is to have more of a, you have to deal with the short-term issue of filling those roles, but also to keep an eye on the long term. Why are people leaving? Can we make this a culture where people want to stay? There will always be some turnover, right? You can't predict what happens in people's lives, but if there are things we can do to make this a place people want to be, that will certainly make your lives easier. I know we've got some professionals that deal with workplace wellness and different things. There are lots of different things that can really make employees want to stay. Also, having up-to-date policies and procedures, process documents will really make that time easier. Cross-training, those are tried and true methods for keeping an organization afloat. You got to pay your bills, whether you have that employee or not. That needs to be able to continue. So there are different things you can do there. It's a good question.
Yes, and I'm glad that you brought up the podcast on audit readiness, because during that podcast, we talked about, in that first week that maybe your CFO or someone on staff leaves, what are the first couple of things you should do in terms of your banking relationships and other key areas that this individual may be involved in. So I think that's definitely a very good podcast to refer back to if you do have that turnover, in terms of really what are some immediate steps you need to take that you may not be thinking of because you're thinking we need to get somebody new in to fill this position, rather than some of those very key areas to protect your organization in the short term.
And Joe, circling back on 1099s, I never asked you, but I'm always thinking this. What about Barry Dunn? Does Barry Dunn need a 1099?
The answer is yes. So Barry Dunn is, I don't want to say technically because we are, Barry Dunn is a partnership organization. organizations, partnership entities. So if a client paid Berry Dunn more than $600 during the calendar year, then absolutely yes, Berry Dunn should be receiving a Form 1099. I think one other thing that I'll mention here too with 1099s, because there was a little bit of a change with this about a year or two ago. Everybody used to receive that 1099 miscellaneous. That was sort of the gold standard form that independent contractors received. They did change that form to a 1099 NEC, which stands for non-employee compensation. So the 1099 miscellaneous does still exist, but most folks in the independent contractor realm, they'll be receiving a Form 1099 NEC going forward. But the answer is yes, Berry Dunn is 1099able.
Well, thank you, Joe and Emily, for your time today to talk through these, kind of lightning round of some frequently asked questions that come up with our nonprofit clients. And to everybody out there in podcast world, thank you for tuning in, and look forward to another topic in the upcoming months.